Hi, welcome. The title of this video is What the HECM is going on? What the HECM is going on with what? Well, first of all, we have to explain what the HECM means. This actually is an acronym, which is HECM, and you're saying, well, what the HECM is a HCM? Well, that is a home equity conversion mortgage. And some of you may be saying, well, what the HECM is a home equity conversion mortgage? And that is what has been popularly coined a reverse mortgage. Now, I'm not a mortgage broker, I'm not an attorney, but I am an income expert in the investment business for 26 years. We focus on optimizing income for our clients on the safe money side, being very efficient with the income for retirees and making sure they can live the lifestyle they want. So you can imagine in that context we get a lot of questions about reverse mortgages. So my job is not to weigh in on the pros and cons of a reverse mortgage, but to educate you, give you some data, some talking points, so if this is in your future, you're well armed and you can have an intelligent conversation. So that's what the point of this video is. And when I say what the HECM is going on, there were big changes October 1st, 2013 with home equity conversion mortgages. So I want to go through those changes. So let's just go through a typical scenario why someone would look at a reverse mortgage, and that way we can backdoor and talk about these changes so you can have the context that you need. So let's start off with just a scenario. Someone has a home value of $250,000. Now, someone may use a reverse mortgage to pay off their existing mortgage, or they want to use it for some form of income. Just so you know, some of the rules of a reverse mortgage are that you have to, when you take out this new mortgage, you have to pay your existing mortgage off. The home equity conversion mortgage needs to be first in line, so you have to pay off the other mortgage. A couple other rules are that you have to be 62 years old or older in order to qualify for this. Speaking of a 62-year-old, let's just talk about a typical retired couple and a scenario that may cause someone to look at the advantages of a home equity conversion mortgage. So let's say you are retired and the income side of your life looks like this. You have Social Security, let's say you're a married couple, and the Social Security total between the two of you is $2,400 between both spouses. Let's say one of the spouses has a pension of $600, and then there's some investment income that totals another $500 a month. So all in, you're looking at $3,500 total. Now on the expense side, because you were diligent and a saver and you worked hard, you don't have a lot of bills, a lot of debt, but you do have that mortgage, and let's say that mortgage payment is $800 a month. But then all the other living expenses, you don't stop buying groceries and paying for gas when you retire. So all the other expenses, let's say, totals up with the mortgage that you're roughly at $3,500 a month, right? And so you're really not able to enjoy the retirement that you were hoping for, and this mortgage is part of the challenge. Now, to compound the situation, let's say that mom falls and breaks her hip, and she comes out, she goes through rehab, and she's just not as spry as she used to be. And it would be really great if we had some kind of in-home caregiver that came by a couple hours each day to help out. And you know what? $800 a month can go a long way in helping out pay for that caregiver. So if we could figure out a way to get rid of this mortgage so mom and dad can have an extra money to pay for that caregiver, then their lifestyle, their quality of life would be dramatically improved. Now let's go over and walk through the math of how a home equity conversion mortgage works for a scenario like this. There are three different ways you can monetize your home value. The first way is to obtain a line of credit, an LLC, a line of credit through the home equity conversion mortgage. And the line of credit, the way this works is you are able to get between 40 and 49% of your home value. Now, this is one of the big changes as of October 1st. Before October 1st, you were able to get up to 70%. That's a big difference, 70% versus 40%. And the reason it's a sliding scale is it depends on your age. So a 62-year-old, as we mentioned earlier, is the minimum age. If you're 62, the most you're going to be able to get is 40%. As you go into your high 80s and 90s, you could edge up into the high 40%, right? So we're going to stick with this scenario of someone that's in their early 60s, 62 years old, so they can get 40%. And you know what? 40% of $250,000 is $100,000. And that's great, but as you can see, before October 1st, again, depending on the age, there would have been another $60,000 that we could have been able to pull out in the mortgage on this home. So the way this works, you have this $100,000, and if you're using a line of credit, it has to be an adjustable rate. Now, July 1st of this year, you used to be able to get a fixed rate. No longer. It always has to be an adjustable rate. The maximum is 13%. 13%. That's not a very good 13 here. 13%, which will put some starch in your shirt. Certainly, we don't want to see that rate anytime soon. So it's an adjustable rate, maximum of 13%. As I said, before July, you were able to get that as a fixed rate. So the way this works is you are able to pull out up to 60% in your first year, up to 60% of your mortgage. So 60% of $100,000 is $60,000. So that's the way the line of credit works. You're able to write a check. You don't have to write one lump check for $60,000. You can write multiple checks, so forth. So now let's take this information and go back over to our scenario where a person has an $800 mortgage payment. Let's just say, to keep it simple, that their actual mortgage balance, is $40,000. So remember what I said is one of the rules is you get a home equity conversion mortgage, you have to pay off your existing mortgage. So as this line of credit is established for you, they are going to go ahead and pay off this $40,000. So in reality, your line of credit is $100,000 less the mortgage, which is $60,000. So that is your, let's call it your functional line of credit, your available line of credit. You're able to take out 60% of this, while 40 already went to the old lender of your original mortgage. So you have $20,000 left in your first 12 months available, and then your 12 months and 1 day, you're able to go in on your line of credit and get the other $40,000. Let me just label this. This is your first mortgage that we had to pay off. So we have this $20,000 available to come into our income side of our balance sheet. And that $20,000 goes a long way of paying for this caregiver. So $800 a month, that's roughly $9,600 a year. We know that we have $20,000 available to us, so that's 2 years worth of care there, and then 12 months and 1 day, we have another $40,000 that's going to come in. So 12 months and 1 day, we have another $40,000. So just in this scenario here, we're basically getting 6 years worth of caregiving, assuming that the $800 doesn't go up, and I don't want to overly complicate the scenario, but you can see why someone would look to do this. So let's go through the other couple scenarios that are not as advantageous as a line of credit, but I think it's important just to go through them because we do want to educate you on this. A second way you can do it is you can actually take a lump sum. You could literally borrow a lump sum instead of a line of credit. A line of credit obviously is available. You write checks against it. A lump sum is they determine the amount of money they're going to give you in the mortgage. It's fixed and nothing ever changes. Now, a lump sum, you're going to get roughly 15% less total mortgage, less total amount of money to borrow than your line of credit. So 15% less than a line of credit. You can also have a third scenario where you can literally have the new home equity conversion mortgage company send you a monthly check, a monthly income, and this one, the amount of money you can overall leverage against your home value is even lower. So that scenario is not terribly good for people. But it's always worth going the math of all three of the scenarios and match them up according to your particular situation to see which one makes sense. Now let's go through the math of how the internal mechanics work from the lender's point of view instead of yours. This will allow us to look at how this affects your heirs, your children, when you eventually pass on. So let's take our same scenario of a home value of $250,000. And let's say that you have your mortgage, like we said before, the mortgage was $40,000. So this is the existing mortgage. And that mortgage cost us $800 a month. In your current situation, if nothing ever changed over time, because you're making this mortgage payment, this $40,000 would be paid off over time. And hopefully over time, your value of your home would go up in price. So in this situation, if you passed away, your heirs would put the house on the market, they would sell the house and pay off the mortgage. So let's say nothing changed in your life, you did this, and 10 years later your house is worth $300,000. The mortgage is down to $10,000. Your heirs sell the house and they net out $290,000 if nothing changes. Now, the way a home equity conversion loan works is your house value is still $250,000. By going through, let's say we use that scenario of a line of credit, this mortgage is paid off, and now you have a new mortgage of $100,000. Over in this scenario, you were making a monthly mortgage payment. In this scenario, there is no mortgage payment for you to make. It's all built internally inside this line of credit. So what ends up happening as far as the balance sheet of your home internally from the lender's perspective is they're adding on the cost of lending money and mortgage insurance. I'm going to touch on that in a second. From the internal perspective of the lender, this is how the home looks on paper. The value is $250,000 and the mortgage amount is $100,000. And because of lending costs that are built internally, remember, they're not your costs coming out of pocket, they're lending costs they built internally, and then all reverse mortgages have mortgage insurance. And I'm going to go through a math scenario there so you can understand how that works a little bit more. But you take these two components and internally it's building on this $100,000 mortgage. So the mortgage is actually growing internally. Now, let's say in this scenario, this happens over a 10-year period of time to keep it simple. And let's say the home value goes up to $300,000 just like we had in the other scenario. And here the internal cost of this goes up to $132,000 over a 10-year period of time. You pass away, your heirs sell your home. So how does this work? Well, the home is sold for $300,000. The mortgage is now $132,000. That leaves a value, an equity value after debt of $168,000. Now the way this works internally is the heirs are allowed to get 95% of whatever this number this 168. So let's say, just to keep it simple, let's say it's roughly $160,000. This is what the heirs would walk away with. So in this scenario, this is pretty rosy, right? You had a person that had a $250,000 house, they paid off their mortgage, they were paying out $800 a month, they had their line of credit, they created some income stream for themselves. The internal mechanics of the cost of the mortgage grew internally, the house value went up, they passed away, mom and dad passed away, and the heirs got $160,000 out. Now 160 is a lot less than 290, I understand that, but this is what was best for mom and dad and giving them the standard of living they were looking for. But the obvious scenario is the one that's not so rosy, and that is a scenario that has a couple other variables. For instance, if mom and dad live a really long time and this 130 outstrips the value of the home, meaning either mom and dad lived a long time and or the home value didn't go up. Let's take the scenario that the house didn't really increase in value. It stayed static. Maybe it went up and then went back down, and it's still at the time of death it's $250,000, and the internal cost of this mortgage ended up going all the way up to $260,000. Well, that's a negative $10,000. Who's on the hook for this? Is mom and dad on the hook for this? Are the heirs on the hook for this? The answer is neither one of these. Mom and dad, they nor their estate have to worry about paying this $10,000 back, nor do the heirs have to worry about coming out of pocket. Now, the heirs don't get any equity, I understand that, but they don't have to come out of pocket in this scenario. That's the risk that the lender, that the mortgage holder, lender, took in order to do this. Now you're asking yourself, well, that's a pretty big risk. Not really. And I'm going to go through a little bit of math. It might be a little technical, but I think it's important. So whenever you have a situation where you have, whether it's an insurance company or a mortgage company, a bank, and they have their algorithm, and their algorithm says, okay, we have a bunch of people between age 62 and 95 that are taking out these home equity conversion mortgages, and we're lending different amounts of money to different people in different income scenarios, and some of these people live this long, some people live this long, some people start here and go here, some people start here and go here. So they plug all this money in the algorithm and they're able to determine what their risk is. Now, this mortgage insurance is an important component to this algorithm, and as you can see up here, I mentioned insurance companies whenever you're calculating risk. So the mortgage insurance that they force you to take is roughly 3% of your lending amount. So over here, where this person had an $800 mortgage payment on their $40,000 mortgage, with this new internal component over here, let's say this $132,000, this new line of credit over here, let's say the mortgage payment, just to keep the math simple, was also $800, but then they tack on $300 a month for mortgage insurance, so the internal mortgage payment is $1,100 a month. Now, as you can see here, just to keep the math simple, this times 12 months in a year times 10 years in our scenario is $32,000. That's why I said let's pretend that we have this $100,000 mortgage and the internal cost of this mortgage goes up to $132,000. That's where I got that math. Well, this $300 here, this is insurance. What is insurance? Insurance pays off when you have a scenario you were not expecting. So it's a scenario such as this. This works in the algorithm very well. Somebody's 62 and they pass away when they are 70. That works very well. But what about the person that's 62 and lives to 92? That is an out of the algorithm calculation. That's what paying this insurance helps that lender do. So it's all part of the math that helps them manage their risk. The important thing you need to focus on if you are looking at this, and if this is your mom and dad, is in this scenario, if things do not work out very well, who's on the hook? And the answer is, well, it's the lender on the hook. And don't feel sorry for them, because they have managed their risk through their algorithm and through using that mortgage insurance. So let's go back up to our original situation here, because we covered a lot of ground, and hopefully this makes sense about why someone would look at a reverse mortgage And what the HECM is going on, the big changes are this one right here, 70%, going from a 70% down to 40%, and not being able to get a fixed rate. It's always an adjustable rate. One other thing that happened October 1st is that the mortgage brokers, their commission went from roughly 9% down to roughly 4%. Now you're thinking, well, why is that important to me as a consumer? Well, the internal costs of a mortgage have gone down, but the consumer did not benefit. This is a negative. 70 to 40, that's a negative. Adjustable rate away from a fixed rate in a rising interest rate environment. And if you're looking for an excellent video on how to make money in a rising interest rate environment, so how to do that, hit the pop-up and go to that video. There's an excellent video on how to combat rising interest rate environment. So an adjustable rate in a rising interest rate environment, that's not a positive. The internal costs went down, but the benefits did not go up as a result of that. So we covered a lot of ground. I hope this was helpful, and I hope it gave you some insight, and at minimum gave you some good data, good talking points, so when you go in to talk to an expert about a home equity conversion mortgage, you won't be scratching your head saying, what the heck is he talking about? Okay, thanks for watching.